Hello fellow human, nobody here with a new stock analysis. Today's question is, should you buy Coca-Cola shares? As always, I will jump straight into my verdict and I will give you my reasons afterward. Let's go! At today's price of $67, Coca-Cola stock is a sell. My price target for 2026 is between $40 and $70, for an average of $55 per share. This means I find the shares clearly overvalued and I see no reason to justify positive share price movement for the coming couple of years. You might be surprised by this apparently low pricing. After all, having consistently raised its dividend for 61 years, Coca-Cola is an overqualified dividend king. But you should not be surprised. In case I didn't make it clear enough in previous videos, earnings growth is the one true king. Dividends, on the other hand, are not what you think. Coca-Cola is a household name like few others. The strength of the brand and the resilience of the company logically attracts many investors. Unfortunately, these are only green flags, and by themselves they are not sufficient to make the stock a good investment. Let me show you why. But first, it's disclaimer time. If you're watching this, I assume you're not a lemming, but a sovereign individual. Nobody can tell you what to do with your own money. I only provide you the tools to take financial matters into your own hands. You alone are responsible for where you place your time and money and trust. So no, this is not financial advice. This is just how nobody invests. Coca-Cola is a global beverage leader that produces, markets, and sells a wide range of non-alcoholic drinks through a network of bottling partners and distributors. They have a huge portfolio of products that include sparkling soft drinks like Sprite, Fanta, and of course, the flagship Coca-Cola and its many variants, water like Dasani and Smart Water, sports drinks like Powerade, juices like Minute Maid, Simply, and Innocent, dairy like Fairlife, plant-based beverages like Ades and some variants of the Innocent brand, teas like Gold Peak and Honest Teas, coffees like Costa Coffee, and energy drinks like Coca-Cola Energy and Monster. They do not fully own Monster, but they do have a significant stake in the company and a strategic partnership for distribution. The company's activities are divided into two lines of business: concentrated operations and finished product operations. Concentrate operations produces and sells beverage concentrates and syrups to authorized bottling partners, who then manufacture, package, and distribute the finished beverages. And as you can imagine, finished product operations is the part of the company that sells ready-to-drink beverages directly to retailers and wholesalers. Finished product operations has both less revenue, with 42% of the total, and lower margins because it involves higher costs related to bottling, distribution, and logistics. While concentrate operations brings in less revenue per unit of sales, it requires much less investment and is easily scalable, which results in higher efficiencies or margins. With all that said, let's now take a look at the company's past performance. In the past 10 years, revenue was flat after declining and then recovering in a V-shaped pattern, as you can see on the chart. And earnings had a very low 2.7% average annual growth. Clearly nothing to write home about, and much less than I would expect to find behind such a strong brand. On the positive side, the gross margin has held steady around 60%, and the net income margin went from an average of 17% before 2019 to an average of 23% since then. But of course, this margin improvement is already reflected in the earnings. Despite the extremely slow growth, the stock has only become a little bit more expensive, as the share price has also gone up very slowly. Over the past 10 years, the stock returned just 5.4% per year, for a total of 70%. Not much, but then again, earnings grew by just 30%. This is excluding the dividend because I'm comparing company growth and stock growth. But we should include the dividend when judging the real returns of owning the stock. So, as an investment, if we include the dividend, the stock actually returned 8.4% per year for a total of 125%. Personally, I don't think this is something anyone should be happy with, but it's better than nothing, I guess. Let's now see what kind of growth can we expect in the future. For the coming 3 years, analysts expect an average annual growth of 3.5% for revenue and 8.4% for earnings. This is an improvement over the average performance of the past 10 years, but it's still such a slow growth that calling it an acceleration would feel like a stretch. Good for them for going from snail to tortoise? You might be wondering, if earnings are supposed to grow by more than 8%, and we add a dividend yield of 3% on top, isn't a return of more than 11% enough? Personally, no, not even then. If you're in the business of stock picking, you might as well aim to outperform the market. Otherwise, why waste the time on research? At the same time, I understand that 11% is not too bad. The thing is that this return can only be expected if valuation is not expensive. If valuation multiples go down because they were too high, the share price will go up by less than 11%. So let's take a look at the valuation. As you can see, valuation multiples today are higher than their 20-year averages. And the thing is, these historical averages are already too high for such a slow-growing company. The revenue multiple is very high, but we can more or less brush it aside for this very mature company. But the earnings multiple is also too high. A PE ratio around 17 would be generous enough, giving a reasonable premium for the strength and endurance of the brand. The multiple compression that should take place outweighs both the earnings growth and the dividend, which is why I expect the share price to go down in the coming years. A 3% dividend is a nice cherry on top for a stock that goes up. But in the case of Coca-Cola, it's not enough to make it an attractive investment. And talking about the dividend, the company already having high net income margin has a dark side. With so little revenue growth, long-term earnings growth is limited because the company's margins can only be improved so much. And the dividend's payout ratio is 68%, which means that most of the earnings are already going to the dividend. So earnings growth is limited by revenue growth, and the dividends growth is, in turn, limited by the earnings growth. When all is said and done, if no new growth is found, shareholders might very well be left with nothing but a mediocre dividend. To sum up, Coca-Cola shows very slow growth, high valuation multiples, and a dividend that, as is often the case with dividends, has very little impact on how good the stock is as an investment. If you found this video only mildly upsetting, please like it and subscribe to the channel for more. Share your thoughts in the comment section and let me know which stocks and concepts you would like me to explore in the future. If you have any questions, just ask. And until the next one, remember, if nobody invests, so should you.